Hi, everyone. Good afternoon. It's great to have you back, Jay. We took a break last week, because of Easter, but you always seem to be with us, on a very good day. And today was a very interesting day. I think, Mark, the S&P was down almost 1.5%, so recovered 2% during the day. So there's a lot for us to talk about. And I know you were on Bloomberg TV this morning at 9 a.m. Just before the opening. So what did you tell the audience? And let's build from that. So welcome again.
Thank you. Thanks, Roberto, and hello, everyone. Yes, it does seem to be interesting days, but you could almost pick any day. It seems like it's interesting. I thought actually the same thing about Bloomberg because the last two times I've been on, which was early March and then the end of March, both days were similar to today. And coming into the open with with the pre-market down big, with Europe and Asia down big. It's now the third time in a row. So I don't know if I should, let everybody know the next time so people can trade around my appearances on Bloomberg. But we talked about a number of things, and one of the things was Tesla. And it dovetails very well with the musings from Friday, which was titled Happy Earth Day, but really dug into what I see as, signs of confusion and uncertainty in markets really all around the world. And I thought that Tesla really encapsulated that with its earnings results last week, right? I mean, Tesla came out on Wednesday morning and reported, or I guess it was Thursday morning, maybe reported Wednesday night, blew numbers away, completely destroyed the estimates. Way better than expected earnings growth, way better than expected production. None of the problems that many of its competitors have in terms of accessing semiconductors or the inputs for the electric batteries, and really just had a phenomenal result. And so the market, the pre-market for Tesla was up about 10 or 11%, and I think it opened around up 10 or 11%. And the markets in general were doing well. The S&P was doing well. It was a pretty good week, Monday, Tuesday, and Wednesday. And then Jay Powell comes out and, again, says something that's not news. It's not new. It's not different. It's not what people haven't discounted or shouldn't say discount, what they've already kind of put into their estimates, namely that a 50 basis point hike would be on the table in May. And yet it seemed to just shock people, or at least shock equity investors. And Thursday and Friday, as we know, were really tough days, pretty much straight line down. And then today, after a really ugly day in Asia, particularly in China, which I'm sure we'll cover, and the market opened again very weak. And so one of the discussions on Bloomberg this morning was Tesla and how Tesla really is setting the stage for electric vehicle producers. And yet after today, I think Tesla's given up that entire 10% move, right? And what's happened relative to Tesla? Virtually nothing. I mean, you can say the Twitter stuff. And one of the questions was from the anchor, John Farrow, was, did I expect a risk to Tesla because Elon Musk would be kind of taking his eye off the ball and focusing on Twitter? And I said that I didn't think that would be the case at all. And you just look at the fact that that Tesla's been able to open two state-of-the-art production platforms on two separate continents, one in Germany and one in Austin, Texas, over the last month. They opened two state-of-the-art production platforms in 1 month. So I don't think that's all Elon Musk. And so I think they're kind of running pretty good, and that they'll be able to sell every electric vehicle that they're able to make for the next several years. And I think importantly, this kind of growth of Tesla, right, from losses to, I think 2 years ago, a small profit, last year a pretty good, healthy, multi-billion-dollar profit, and now profits of that size coming almost every quarter. is emblematic of what we can expect in some of the innovation space that, you know, we've been talking about as an area of opportunity over the last couple of weeks, maybe the last month or so. And I think that's important to keep in mind here. And I'll note that today, ARC, which is the poster child for, you know, the innovation space, was up 3.5% today, and was one of the first things to turn green this morning. And so it suggests to me that a lot of that selling has been done, and now people are looking and taking out some of the recent winners, as we've seen in the commodity space again over the last couple of days.
Well, that's very interesting, and you know, building on, you know, from Tesla, I think, you know, you lay out very nicely in the Musings how this sort of confusion is reflected, you know, in the three regions, you know, in the three you know, big regions. So why don't we start with Europe, which seems to be you know, of course, you know, it's close to the conflict. And I also wrote today that, you know, the markets seem to be you know, very focused on this toxic cocktail that we have today, which is the war. You know, what's going on in China. People are nervous about, you know, lockdowns, and also you know, people panicking about the Fed. So and of course, you know, we have to see through the fog. But let's begin, you know, with Europe first.
Sure. And I think that's, you know, your description is absolutely right, and is kind of what we talked about in the Musings, that, you know, our tripolar world thesis, again, regional integration in the three main regions of Europe, Asia, and the Americas, also allows us a framework to kind of look at these different regions and put a coherent picture together. And I think it's one of the advantages, one of the distinctive advantages we have at TPW Advisory in terms of having that tripolar world framework and being able to talk about each region with a kind of coherent framework and construct. And so with Europe, it's this sense of confusion, right? Because you have, on the one hand, markets pricing in, I think, 80 basis points of tightening by the ECB this year. At the same time, the consensus is that Europe is going to enter recession this year. And I don't see how those two things, you know, coincident, work together. Yes, one can happen after a central bank tightens too aggressively and pushes an economy into recession, but that's not what we're talking about. We're talking about rate hikes and recession in the same year. And then to cap it off, you have the PMIs that came out last week, way better than expected.
Exactly.
Both service and manufacturing for April. So this is no longer, you know, pre-conflict data. This is not old data, not stale data. This is current data saying that the PMIs, both on the manufacturing side and the service side, as COVID ebbs, which, as you know, is a big theme of ours. We believe that the ebbing of COVID is going to have a significant effect on economies around the world, a positive effect as supply chains unsnarl, as labor markets become more flexible, as more people come back to work, and as the service sector really takes over from the goods sector, right? We've had 2 years where everybody wanted goods and there was no services because no one was going out, no one was traveling, et cetera, et cetera. Now that we're switching from that goods demand to service demand. You look at restaurant bookings, airline bookings. Airlines are basically back on a global basis, back to about 90% of pre-COVID levels. But yet, if you look at JETS, the airline ETF in the US, which we have in our global multi-asset model and in our thematic TPW 20 model as our reopening play, JETS is still down 25% from its 2020, down about 25% from its 2021 high and about 45% from its pre-COVID levels. So the departures are basically back to where they were, and yet the stock prices are still down dramatically. And so when you look at the PMIs for Europe, the composite, so putting together the manufacturing and the service, was the strongest it's been since last September. So is that recessionary? Does that suggest that a
Yeah.
recession is imminent in Europe? Absolutely not. And yet this is what the markets have in their mind. If you look at all the worries about natural gas and oil prices and impacts on inflation, natural gas prices in Europe are basically back to pre-conflict levels. You had a huge spike and a huge drop. Brent oil is down 20%, 20 to 25% from its peak, right after the invasion at the end of February, early March. So we've kind of round tripped, but yet it's in the minds of investors that we're going to have this inflationary surge, and it's going to, dampen demand, et cetera. And what's really interesting, and I read about this over the weekend, is that now those prices, those peak prices, were captured in the inflation data. And so unless those prices keep going up, the impact of energy prices on inflation is going to be disinflationary, because you're not going to have that same spike. And this is not, the market is not really, I don't think, thinking about that. And so I do think to maybe take the other side a little bit, that there is a rising chance of a European oil embargo on Russian oil. And a lot of people,
not gas, right?
A lot of people are speculating that Europe wanted to get through the French elections, which again, a pretty solid result for global governance, let's say, and global leadership, completely discounted by the action in markets today. Got absolutely no play whatsoever. But there was the thinking is that the decision makers in Europe wanted to wait until after the French elections before they really push for an oil embargo. And as I know, I'm sure the audience knows, Russia gets most of its energy money from oil, not from gas. And so you can do two things. And not taking oil from Russia is something Europe can handle. And at the same time, you hit Russia the hardest in terms of money flows in the pocketbook by not taking down the oil as opposed to the gas. And so I think that is something that we can kind of think about. And most of the investment banks, when you look at their oil forecasts over the next couple of quarters, they see oil at around 125 to 130 versus I think Brent today was at 102 or something. The peak back in early March was 135. And so I think just to kind of wrap it all up, at the same time, you have earnings coming through, and earnings are pretty constructive in the US and in Europe. And I think you have a situation where cyclical stocks, again, in Europe versus defensives, and this is somewhat similar in the US, cyclical stocks are trading at like a 20-year low on a relative valuation basis to defensive stocks in Europe. JP Morgan just put out this data over the weekend. And so it's quite interesting because, of course, again, as we've talked about before, one of the positions we have is in the European banks. And European banks have been hit pretty hard, even though rates have backed up, and they should benefit from that. Again, with this general tone of kind of risk off and memories of European banks not being a good place to be in risk off environments, they've been sold pretty aggressively. So I just think that in the European case, this idea of multiple rate hikes and recession at the same time as solid PMIs, the best PMIs since September, it just doesn't jive. And I think hopefully once we kind of stabilize a little bit, people are going to go back and look and say, okay, look, we've already, this April data, May data is likely to be somewhat similar. We're not on the cusp of a recession in Europe. We're not on the cusp of runaway inflation since the prices of natural gas, et cetera, have come back to where they were pre-conflict. And so there's an opportunity here with a, massively oversold. I mean, you can count the number of weeks of, consistent European equity fund outflows. B of A does good work on that. And it's, it's just been weeks and weeks and weeks of net selling of European equities. to the point where very cheap versus rest of the world, very cheap versus history, cyclicals very cheap versus defensives, and very low earnings expectations. I think now the consensus is for earnings growth in Europe to be 3 or 4%. I think not even 5% for the full year, and I believe that that's going to be very beatable. And it may be, as I suggest in the musings, that it will be the earnings that kind of show us the path forward as we work through all these issues that are of concern.
Absolutely. And to add a little bit more on Europe, there were a few, statements and forecasts out of Germany today. If I'm not wrong, I think it was the government statistics agency that said that they basically ruled out a recession. Of course, for the first quarter, they already know the numbers, but they said, it's for the second quarter. But they raised the inflation estimate to about 6.6 or 6.2% for the year. Do you think they could be overreacting a bit on inflation and borrowing from something that you actually said on the musings, which is, you should not extrapolate when things are so negative, because we could very well see, disinflation in energy prices, and that's of course always a big thing. Do you think that could be the case?
The bulk of the inflation readings in Europe is energy related. Without a doubt, very clear. It's less so in the United States. The inflation issues in the U.S. are more than simply energy, but in Europe, it's mostly energy. That's interesting because the consensus for Bloomberg for the U.S. inflation at the end of the year is 6.2%. So I don't know, maybe they just looked at the Bloomberg U.S. consensus and said, yeah, we'll put that number in there for Europe too. But I think that seems high to me. But again, the point is that you're not likely to have a recession and have energy prices or inflation running that hot. If you have a recession and demand cools, then prices should fall because the demand is cooling and prices have to drop to generate the demand. And so, I think it's a very, very tricky environment, a lot of cross currents, a lot of things that we haven't had to think about, like war in Europe, a lot of uncertainty around energy security and energy dependency with Russia, et cetera. So a lot depends on policymakers, but by the same token, you also saw over the weekend Germany come out and say they're going to borrow another $40 billion to offset some of the costs of all this. And so I think we need to remember that there's still pretty significant fiscal stimulus coming from the Next Gen program in Europe, and then also the Renew EU power generation program that's starting to materialize. And so I think this is something that Europe has, which the U.S. doesn't have, right? U.S. we're reducing the deficit, the fiscal stimulus is ebbing and contracting, and while monetary policy is tightening. Europe has a much better policy mix than the U.S. does. Fiscal stimulus and monetary policy with the ECB, I think, going to take its time, particularly if, as I think is going to be the case in the U.S. I feel very confident that inflation is in the early stages of rolling over in the U.S., particularly if the European inflation also starts to roll over. And should be with the energy prices coming down, it should manifest itself quite quickly. Then I think that inflation forecast of 6% for the full year probably will need to be revised. I think a lot of, and this is your comment about extrapolation, which I wrote about in the musings, I think is really important, whether it's down markets or up markets. You need to be careful to extrapolate, and particularly in the commodity space where we've just seen it, right? You had huge spikes in natural gas prices in Europe, big spikes in Brent prices, big spikes in wheat, et cetera. And they've all come right back down. They don't just keep going up, they come down. And so you have to be careful as an investor to not extrapolate, right, and be aware of the likelihood of a significant drop to offset the spike, and then we figure out kind of where we go from there. And so I expect that to be the case in Europe. And to finish on Europe before we move maybe to Asia and then end on the U.S., the conflict obviously continues. I've been a big believer that time is not Putin's friend. I continue to think that's the case, but I also recognize clearly that the conflict is going to continue for a period of time. I think it's now pretty much accepted. I don't know if it's wisdom, but accepted thinking that Putin wants to take as much territory in the east as he can and be able to declare some sort of victory. But at the same time, if there is an oil embargo, then the potential for the Russian economy to really implode pretty quickly, I think, really manifests itself. And that could help shorten the conflict, as well as, of course, what happens on the battlefield. And there, the U.S. and others in Europe and elsewhere have been supplying Ukraine quite aggressively with some heavy equipment, et cetera. And so I think my hope is that we don't extend too much further, but I have to also recognize that my view of a relatively short conflict has not proven to be correct. And so we have to kind of watch and observe. But the implications for the energy space in Europe seem to have been pretty well contained. And now we'll see if there is an oil embargo. I'm sure you'll see Brent, shoot up a number of, maybe reasonably significantly, somewhere between the 100 where it is now and the 130 where it peaked in the early stages of the conflict. But that will be probably the signal that, okay, from here on, we're going to be relatively stable in terms of the direction.
Yeah, no, I agree. Let me just make a point on Europe, and let me know if you agree. And then one question for you on the conflict.
Sure.
I have the view that the elections in France were actually better than they seem, because if you go back a couple of months, maybe 3 months, Macron was leading Le Pen. He had over 60%, or maybe 62, 63%. And what has led Le Pen to catch up, was the dissatisfaction with inflation. Was basically, this feel-good factor. People were uneasy with rising prices, and of course, the incumbent always loses when you have inflation or unemployment. And so it's not really, the vote for the far right, but she got, this dissatisfaction. So it actually would read, he would have done better if it wasn't for this, inflation pickup, which is of course none of his fault. So I want to know if you agree with that. And then there's a question on the war, which is there any scenario where you see which would lead to a compromise? Because I agree with you that this is we're going to have a long conflict, because neither side can afford to lose. But is there any way where you see, okay, this could lead to some kind of compromise or a settlement or a ceasefire?
Yeah, good questions both. On the French election, I would agree with your description, and I think it was a pretty solid victory. I mean, I would also point out that Le Pen changed a lot of her views that she had run on previously, and much more kind of moved much more toward the center, particularly in relation to the euro and Europe and things of this nature, kind of the integration that we talk about in the tripolar world. She's moved quite a bit over the last couple of years since the last election. And then the second point I would just make is that, let's keep in mind that it's not, it hasn't been the norm for French presidents to be reelected, right? I think Macron is the first in 20 plus years to get reelected, and so that's also a point in favor of terms of a very solid victory that hopefully can be translated into more success on the policy space, and again a continued development of Europe more integrated. And the last point I would say on Europe, and then we'll get to the conflict, is that let's not forget that the Digital Service Act was agreed upon over the weekend in Europe, and that's now the third big tech legislation that's been agreed. And what really caught my eye was that the Digital Market Act and the digital mix up the names of the two, but the two recent legislative decisions on the tech side, both are going to be kind of run by Brussels and by the European Commission, not by individual states. The Privacy Act, which was the first act done a couple of years ago, that's controlled by the states. These last two are controlled by the European Commission, which again reinforces the idea of integration, and to me suggests that the European Union is starting to recognize that it really gets traction when it kind of comes together and acts as one, as opposed to 27 individual states. And so I think this is something that we're gonna be paying a lot more attention to over the coming quarters and over the next year or two, is Europe's role as really being the tech regulator and being driven by the EC and not by individual states. So then on the Ukraine, I do think there's hope for compromise. I continue to feel that the Russian military capability to do much more than simply destroy things is not very high. I do think Ukraine seems to have been supplied quite aggressively during this period where Russia had to take its foot off the gas because its forces were, the attrition had been so significant that the forces were no longer kind of fighting forces. That allowed the West to kind of resupply the Ukraine. And so now you have the Ukraine, I think, a much better position to fight Russia in the eastern part of the country. And so that, the issue of territory, the issue of compromise, I think Putin is searching for something to declare victory, right? Something
before May 9th,
to make all this pain and suffering that I think on the economic front in Russia is going to be felt for years and years. I think this is very, very damaging for Europe. And by the way, just to kind of dovetail back to the oil embargo, Russia does, in terms of time not being Putin's friend, Russia has very little oil storage. So if there is an oil embargo and tankers cannot get insurance to ship elsewhere, the potential for wells to be shut in and for production to decline is very real. And my reading suggests that Russia is already producing about 10% or 1 million barrels a day less than it was producing pre-conflict, in part because of the lack of finding buyers. And so that could also really shorten the time frame for Putin to make some sort of compromise. But I think the outline for compromise is there, and both on the Ukrainian part, and it's really kind of up to Russia. And as I said, I think Putin recognizes that since he kind of put this into motion himself, it seems, he needs to find something that he can kind of cast as a victory in order to kind of sustain his own personal position in Russia. And that's where it kind of seems to me to be at this moment.
Mm-hmm. No, makes total sense, and that has to happen quickly because it's they celebrate the victory day for the war on May 9th, so it's a couple of weeks. It's less than a couple of weeks.
2 weeks from today.
2 weeks from today, exactly. And just a reminder to finish on Europe, the last president in France to get reelected was Jacques Chirac, and it was actually against Marine Le Pen's father, who was a much more toxic figure at the time. So I mean, the results were like 80-20.
Yeah.
And that was the first time they formed the safety belt, the cordon sanitaire
Hmm.
around it. So let's move to China. So it seems that this is a very critical week in China, right? People are nervous about the lockdown in Beijing, and there's also the story about the Politburo meeting. So what are you seeing there, Jay?
Well, we've been bullish on China, and we talked about. I almost hesitate to bring this up, but we have to be fair both in
Yeah,
good times and bad. And our term for China was China 2022 glide path,
glide
and
path.
it's been it's been anything but a glide path so far for sure. And it's been painful. I mean, we're long equity as well as the debt, both local currency and dollar. And the debt's actually done better than the equity, which is kind of a switch because in the U.S. the debt has done worse than the equity, right? I mean, if you
Yeah.
look at the 20 and 30-year ETFs for the Treasury market, they've done worse than the S&P. In China, it's the other way around. The bonds have, until very recently, done much better than the equity. So, where are we? The way I look at it is that in March, we had that period of time where people started to worry about China being uninvestable, right? Remember the JP Morgan report
Yeah.
on China tech and the tech selling off dramatically, and the government coming in roughly the middle of March and saying that, we are believers in the market. We're going to support the market. We're going to finish the dealings with the tech companies. We're going to help the property developers, et cetera, et cetera. And that led to a 40% move in one day, 40% in one day for the China tech ETF.
K-Web, yeah.
And now, but so after that, obviously the market's saying, okay, words are fine, but actions are more important. Show us the money, and so to speak. And China really has not done that, right? They've had a couple of opportunities to do things on the rate side, on the monetary policy side, and outside of, some pretty small stuff. And I guess last night the cut in the reserve rate requirement is a little bit bigger, but kind of not much happening on the monetary side. And likewise on the fiscal side, there was a report last week of 20 odd measures to support the economy. Most of them were pretty small beer and kind of were dismissed by the investment community. And so where we are today, of course, is that lack of policy action follow through to the verbal intervention, coupled with the COVID outbreak in Shanghai and now concerns of that in Beijing, have led people to basically puke their China exposure, right? We saw that certainly overnight with China down 5%. We saw that in the ADRs and China ETFs today. Though I will point out that K-Web ended the day in up in the
Yeah.
US trading, right? And K-Web is still 20% above where it was before that verbal intervention. So that ETF, that space has not gone all the way back to the pre-verbal intervention levels. But I do think, the COVID stuff is worrisome because the rest of the world seems to have kind of been through COVID, right? China has done the zero COVID approach and did not have anywhere near the effect of the last couple of years as was felt certainly here in the US and in Europe to a large extent. And so now they're trying to do a zero COVID approach to Omicron, which we know is very, very transmissible. The offset to that is that China also has the capability of doing these kind of targeted, localized lockdowns and mass testing people and just keep doing it until cases are kind of peter out because there's no transmittability. And I think that's kind of where we're hopefully getting to in Shanghai. I would also point out that most of the factories are restarting production. Tesla, for example, has restarted. Other companies are restarting. And so, yes, I mean, you have a near-term impact on Shanghai, which is a huge, metropolis, and its outlying areas are very important on the production side. Beijing is much more kind of government, run, not as much business, but still lots of business around and outside of Beijing. So there's obviously concern that, you can write off April, right? Let's say in terms of thinking about growth and earnings and stuff, right? Q1 for China was 4.8% growth. So relatively okay, even though the second half of March was starting to be affected. April is going to be, kind of a lost month, I would think, for any kind of robust growth. But if the lockdowns are able to be kind of eased and production restarted, then you move forward into, May and June with hopefully some policy response, as you noted. And I was going to note the Politburo meets, I think, on Friday. And typically this meeting is about the economy. And for sure, this particular meeting will be about the economy. And perhaps this is when there's some more aggressive policy responses around both perhaps the fiscal side, where China really hasn't done the fiscal stimulus that Europe and the US has done over the last year or two, as well as on the monetary side, which, as we talked about before, inflation is quite low in China, and they have positive real rates, fairly significant positive real rates. And so there's potential room for reductions on the monetary side. And then you have the currency.
Yeah.
And of course, now there has been a little bit of weakness in the yuan. And so markets are, in this environment, markets are picking up on that and extrapolating, significant currency risk, which I don't really agree with. China is a controlled currency, right? It's not a free floating currency, so they control it. It has been one of the strongest currencies in the world. That was one of the things that led us to our position in local government debt, in local currency, in part that real rate, in part that strong currency. We've now given some of that back, obviously. I noticed today that C-bond, which is the China bond ETF, was down almost a full percent. And then I looked at the volume, and the volume was 5 times the average of the last 90 days. So, when you have 5 times the volume, you basically have an overabundance of sellers and a lack of buyers, and you have the price has to move to, kind of meet the two. And so I'm more sanguine about the currency than what I'm reading. And I would think that if there is some policy response, then that should stabilize that issue. And by the same token, let's remember that China's kind of slowing here is probably what's driving the weakness in the commodity space, right? Whether it's oil,
absolutely,
or iron ore, or copper. All these things have come off the boil, which on the inflation side is good, right? That's good because it should dampen inflationary effects in Europe and in the United States. So yeah, as I said, it's a very complex environment. But to me, I think China needs to be more aggressive on the policy side. Certainly as a holder who's now underwater, particularly on the equity side, I want to see some policy action. And if I don't see that on Friday, then me and others are probably going to have to rethink their positioning there a little bit. And then we should also talk, Roberto, a little bit about Japan and the yen, right? The yen has been down, I don't know how many days in a row. The dollar, I know, has been up. DXY, I think, has been up something like 15 out of the last 17 trading sessions. So I think this, too, is getting a little long in the tooth, right? I mean, much as we saw with the commodities, up until 3 days ago or 5 days ago, last Thursday, commodities were pretty much on fire. Those were the things that were holding up one's portfolio as other things were getting hit. Now they've been hit. And now the dollar, up 15 of the last 17 days, is probably pretty ripe for some pullback and this fever to kind of break, right? I just see these extrapolations and these moves are just, just all one way, and then they snap back the other way. And it's very dangerous in a very tricky environment. And one of the ways we've tried to deal with it is to not trade around things very aggressively, because you just run the risk of being whipsawed and getting it wrong on both sides. And so for us, Japan, with the cheapest currency, I think on a real effective exchange rate or OECD, almost any way you want to look at it, the yen is about 30% undervalued, and so it should be good for Japanese companies that are selling internationally. The problem has been that the correlation between the yen and the equity market has turned positive over the last 6 to 9 months. JP Morgan did some work on this recently as well. And so that positive correlation kind of reflects the fact that Japanese bond buyers are buying offshore bonds, and foreign investors in the Japanese equity market are selling. And so you have that relationship of the two working, in this case, against folks who are holding Japan equity as a foreign investor. So to me, here too, we're looking for some policy response. A fiscal package has been expected in Japan for some time. That should hopefully come through fairly soon. Now that the fiscal year is over, the Japanese companies, I'm sure, have a much different yen dollar rate in their forecast than where it is presently. That should support earnings for Japanese companies. And again, we know Japan, very, very cheap stock market. So it's a lot of things are being pressed. A lot of bets are being pressed. And now on the currency side, in Asia, whether it's the renminbi or the yuan on the one hand or the yen on the other, a lot of action there. I think, as I said, the yuan in China is a controlled currency. The yen dollar, it's been going one way for weeks and weeks, probably due for a break at some point and a little stabilization there. And it may well be that you have the U.S. We've had our run on rates. We're going to get the May FOMC. It's going to be 50 basis point hike. We'll get that out of the way. We'll then get the inflation number for April, likely to show a fairly decent decline from March's 8.5%, and then perhaps the dollar starts to roll back a little bit as the extrapolation effect unwinds and things start getting back a little bit more towards the middle. I think some of these things have gotten, certainly in the case of the expectation for rate hikes, the impact of inflation, the impact on the dollar. I think all these things have gotten a little extended.
Yeah, no, I agree, and we'll cover that, in the end when we, sum up things. And so, how about the U.S. Using your same methodology of how things are a bit confused and too much fog. So how do you see the U.S. these days?
Well, as we said at the open, right? I mean, Jay Powell speaks on Thursday and says a 50 basis point hike is on the table, and markets just puke the equities.
As if nobody knew, right?
It's like yeah. I mean, and again, we've been trying to say peak Fed hawkishness and X number of rate hikes. I think we started at 6, then we went to like 8 to 10. Now it's like 14 rate hikes are priced into this cycle. And we now have a Fed funds futures rate that suggests the Fed funds rate is going to be at 2 to 2.25 by July, which suggests a 50 basis point hike in May, 75 in June, and 50 in July. And a month ago, there was virtually no expectation of rates being there that fast. And so we've had a super aggressive kind of preemptive spike in rates, right? The 2-year has rarely, if ever, moved this fast pre-Fed tightening with only one hike. The 2 years already at 260 or something, give or take. It was at 60 basis points like 3 or 4 months ago. I think it's pretty close to being unprecedented in terms of the speed of the backup in rates. And now we're at 3% on the 10-year. I think that's a pretty significant level. It's a nice round figure level. A lot of resistance, I think, in and around that level, according to some technical analysis I've looked at. So I think we've probably gone about as far as we're going to go in the near term. And I'll note that today, the 10-year backed off by about 10 basis points. And so last Thursday, it's kind of funny how this works, right? Last Thursday, we were at roughly 3% on the 10-year.
Yeah.
Today we're at 2.8%. And yet stocks have been weak and weak and weak. So there's, again, all this uncertainty and confusion. I think the Fed has done a pretty fine job of jawboning rates higher. You look at the mortgage rate in the U.S., right? 5%, the highest it's been in decades. So you're now at a point where you're probably going to have an effect on things like the housing market, which is pretty important. You've now priced in a Fed funds rate of 2.25 by July, which is pretty significant. And as I said, I think we're coming to the peak or the break of the fever break of all this inflation and rate hike uncertainty. And to me, the next couple of weeks, we're right in that. And this is where it's always kind of tricky as an investor. We're right in that space where we could have a pretty aggressive reversal, but the market is pressing and pushing people to kind of make decisions now that they may have to just unwind and reverse in a matter of weeks. If we get the 50 basis point hike, if we get the peak of inflation in a pretty clear sense that inflation is going to start to ebb. And again, we talked about oil prices, used car prices have rolled over. Gasoline prices in the U.S. are down 5% plus from the peak of about several weeks ago. You have a number of things starting to decline in price. We talked about the disinflationary effect of energy prices if they don't sustain the high levels earlier. So I think you can look at, and as I said in the musings, what if we get to the point where in July, inflation has come down from 8.5 in March to say 5%, and the Fed funds rate is at 2% or 1.75 or something like that, and growth is kind of okayish. Where do equities trade in that environment? And do people start to then extrapolate, inflation continuing to gradually go down, where growth is able to stabilize in that high nominal growth environment that we've talked about for some time can manifest itself, where you have, let's say 4% inflation. Right now, the consensus for U.S. inflation at the end of the year, so December inflation year over year, is over 6%. I think it's going to be much less than that.
I agree.
Right? People are saying there's equal chance of recession next year in the U.S. I think that's highly unlikely. So our view here is, again, that high nominal growth environment where you have 3 to 4% inflation, 2 to 3% growth, 7% nominal growth, versus the pre-COVID level of about 4% nominal growth, right? 2% real, 2% inflation. And that 6 to 8%, let's call it nominal growth rate environment, means that the earnings expectations, which are now, again, single digit for the U.S. this year, single digit earnings expectations, should be quite easy to beat.
Yeah.
And we're seeing that already here, where Q1 growth is probably going to be quite slow. It comes out, I think, next week. The first estimate for Q1 GDP growth, probably going to be around 1% quarter over quarter. But yet earnings growth is, early indications, right? Where I think about 20% of the S&P is reported. Earnings growth, again, is doing better than expected.
11%, yeah.
70% or so of companies are beating expectations. And of course, this week we have all the tech names. So a lot of attention being paid here. This week and next week will be the big earnings weeks. But earnings estimates have been increasing. So for all the negative commentary and the weak price action, earnings estimates, whether it's Q1, Q2, Q3, or Q4 in the U.S., have been gradually going up. And this is, again, something that doesn't get a lot of attention because it doesn't fit the prevailing narrative of, everything's horrible and we should sell everything. But the reality is that the earnings bar is low. High nominal growth environment suggests earnings beats will occur, and that should help stabilize stock prices. And so when I think about kind of where we are, I think fever break, which is the musings we wrote 2 weeks ago, is coming. We're going to break this fever of ever higher inflation prints, ever more rate hikes, ever more concern over recession, etc. I think that's coming to an end here in the next couple of weeks, and we're going to start a different perspective, particularly if energy prices stay relatively well controlled. And again, that's where China being, somewhat slow helps. That's where the concerns around Europe probably a little overstated. And here in the U.S., as I said, gasoline prices have already kind of peaked and rolled over. And so for me, that's kind of the environment that I'm looking for. And again, the trick is, do you have the wherewithal to kind of stay in your positions, which are working against you? I mean, it's been a pretty tough month so far in April. But again, up until last Wednesday, it was a pretty decent month. Basically, we're flat up till Wednesday. And then Thursday, Friday, and today have been, pretty ugly days. And all of a sudden you're down, a couple of percentage points. And so do you have the wherewithal to kind of stay with it, with this idea that May, which is, coming up next week, you're going to get the FOMC meeting, you're going to get the inflation print, you're going to get Q1 GDP, and earnings, and people may reassess, maybe we've been a little bit too negative. And the things like ARC, up 3% today, and KWeb being up today, maybe suggests that a lot of that selling has been done. And of course, we've said that a couple of times, and we're in a range, right? We've basically been round tripping between 4,200 and 4,600 on the S&P for some time. And so we're in that range. And again, if you don't have to trade, you probably shouldn't, because you're just going to get chopped up in that range. You're going to buy high and sell low, because the pain, in days like today and Thursday and Friday, is pretty intense. And so you sell, and then you buy once things stabilize, and you're just, it's a difficult environment, and one has to be kind of disciplined in their approach. For us, we adjust our model portfolios once a month, as you know, at the beginning of every month. And so that's actually been a pretty nice kind of break, a forced break, right? Where you really don't trade unless we're seeing some really amazing things, either up or down. We don't trade in between for the most part, and we don't change the models for the most part in between. And that discipline is actually not a bad discipline to have in an environment like this, where the tendency is to look at your screen and see all the red and go, I got to get out, or look at the screen, see all the green, and say, I got to get in. And, you just chase your tail, which, I'm sure you've been familiar with, I'm familiar with. It's something we want to try and avoid.
Yeah. And just to add a joke, maybe, the best indication that inflation has peaked, is what, was on the cover of The Economist.
I was going to mention that. You beat me to it. Exactly.
I mean,
exactly. The famous contrarian indicator. When I was at Morgan Stanley, I used to have a whole row of, like Barron's covers and Economist covers, where they just they top ticked whatever thing they were talking about. And I think this inflation one is probably, the next candidate for exactly that. The Economist cover, on inflation. That's perfect. I think that makes perfect sense.
And even the article, I mean, they say, the Fed could, jack up rates to 5 or 6, Fed funds, to 5 or 6%, which is, is way overdone.
I would think so.
Yeah. No, so it's good. And also, I mean, you mentioned on the musings that, of course, you kind of touched on this already, which is the fact that, the bonds have been oversold. So you have this moves. I mean, it just went too fast. So, I mean, could it be the case where, if you have a minimum surprise on, can be the PCE, index this week, or, any inflation measure, if we see a slight positive surprise, or not even that, I mean, even if the number matched expectation, but if it's better than feared, uh, you think it could have a major positive impact on the markets?
I'd like to think so. I hope so, but I think it probably needs like a couple of data points, right? Because we've
Yeah.
really been baked into this idea of ever higher inflation. There's a lot of cross currents. So I think it's probably going to require a couple of data points, but you're starting to build that case, right? You can
Yeah.
build that case with Brent down 25% from its peak. You can start to build that case with used car prices down reasonably significantly for several months now. You can start to build that case with gasoline prices in the U.S. down now 5% plus from their recent peak. So you can start to build the case with some data points, and then you get that. I think a lot of people who I talk to say, yeah, the base effect, we already know about that. That's a given. I'm not sure that's the way markets will take it. If you go from 8.5 to 7.5 to 6.5 to 5, I think something, anything like that, and we'll have to recast a lot of this stuff, and markets will react significantly differently. And then on the other hand, by the same token, growth maintains a decent pace, and it shifts from the goods side, which is still quite strong, right? Industrial production last week in the U.S. was quite strong. So the goods producing side is still robust. In the service side, as we talked about with travel, et cetera, off the charts. I mean, I tried to get a late checkout down in Charlotte, North Carolina this weekend, and the hotel wouldn't give it to me, even though I'm a good customer for that brand, because there was a concert taking place at the convention place next door. And so they were sold out. I tried to get on a flight from Charlotte back to New York over the weekend, and it was completely full. Couldn't get on the flight. So, there's a lot of movement on the service side that I think is going to be sustained. People want to be out. They want to be spending. The Delta, I quoted the Delta CEO saying that they've never had demand this good in his entire career. This guy's a 30-year veteran of Delta Airlines. Never seen demand this robust. So that is the kind of thing that you do not hear when you're going into a recession, right? I think people are underestimating the amount of money that people have in their pockets that they've saved over the last couple of years, the desire to travel, to get out and spend a little bit of money. And I think that's going to be quite strong over the course of the summer. So when maybe kind of wrap up, because I know we're running out of time. This hour always is the fastest hour of the week, Roberto. I love it. We're always
Likewise.
If you look at positioning, Goldman Sachs positioning indicator is off the charts light positioning. If you look at the put call ratio, it's the highest it's been in 2 years since the bottom of COVID. If you look at the ARC performance, the KWEB performance, if you look at the fact that the commodity producers, the XLEs, the URNMs, the PICs have all been sold pretty aggressively. PIC is down like 12% in 3 days. If you look at Brazil, EWZ, right, which has been finally playing its role as a commodity play, it's been taken to the woodshed over the last week or so. So these things they've been sold. So you've really sold the innovation stuff. You've sold the FANG names pretty decently. We'll see how they respond to earnings. Europe and non-US, China, Japan, all been sold aggressively. Now we've sold the commodity producers, the defensive stocks, utilities, et cetera, very expensive relative to history, very expensive. So the idea of selling something that's depressed and has been sold aggressively to buy something that's expensive relative to history, that's really not the way you want to do business. So to me, we've been talking about the innovation space, about Europe, about gold, and about China. And, several of those have not been very good over the last week or so. But to me, I think the setup is still pretty robust for all of them.
That's excellent. So yeah, right at the mark, and you closed very well. So yeah, it looks like things are turning. I mean, I think it was actually very good that we spoken on a day that we saw a turnaround like today. So let's stay focused, stay calm, and keep going. So thanks very much, Jay. It was a great session, and look forward to see you in a couple weeks.
Excellent, Roberto. Always a pleasure. It's great stuff. Like I said, the fastest hour on my calendar. So great conversation, and we'll see you again in a week or two.
Thank you. Bye bye. See you.
Bye bye.
Thanks, everyone.